Hello, YouTube. Could the S&P be heading for a 15% rally in 10 weeks? Or could we be repeating what happened in 2008 like we have for a large part of 2022? If you remember, we've been looking at a pattern here for looking at the top from 2008 to 2022, and it's matched almost perfectly. And it shows us that we are now due for a continuation on a dead cat bounce or pretty much just going up for a little bit longer. And the reason why this is so important to me is because as we were fading down here, we note that we don't really form a lot of higher highs, or mostly lower lows. And now as we get here to this portion where we're actually forming higher highs for pretty much the 10-week period, that's really what I'm paying attention to. Two candles is not a pattern, so we really need to see these bulls show up to advance the chart higher into this next week. However, with a high of the week close, closing out at roughly 374, there is pressure building up, which should get released into early next week. Does that mean we will close at the high of next week? Stay tuned. In this video, we're going to walk you through everything you need to know for the week ahead that matters. So what I really want to point out here is if we now look at 2008, and there's the upside target that I talked about that we will circle back to in a moment for Morgan Stanley's Mike Wilson, where we could go above 4,000 on SPX before ultimately putting in that bull trap where we repeat 2008 and do form our new lows. So what I want to focus on here is the 2008 period now, where if we zoom in, and what we're looking for here is that history does not repeat itself, but it often rhymes. And by rhyming, we just want to look and see whether or not the fundamental and technical backdrop are both kind of telling us the same story here. So in 2008, even though we do form some bullish engulfing candles here over the course of 4 candles, we got 2 bullish engulfing. And what that means is that we do print lower lows. What I am more focused on is the fact that we actually form high, higher 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 high, and then we stall out. So that's the period that I am looking at right now. It's can we start a short-term move, a bear market bounce, where even if we do close red next week, there is some evidence to show that. We'll go through that in a moment. If we're able to form those higher highs, that might be all it takes for us to continue in this bear market bounce and form that high. That is really what I want to go through this week. So at a very high level, the S&P is now at a very key area as well because we're right around that 200 moving average. And in the article from Mike Wilson, we're going to break down point by point what he's talking about and the reasons why we could actually go higher. His target here, just at a high level, is going to be 4150. So that 4150 area, he's looking at the 200 daily moving average. What I want to look at is actually going to be the weekly moving average as well. So we got 420 here. That's our 200 weekly. Sorry, our 50 weekly. And if we look over time, once we start falling in between the averages, we go 50 to 200 to 200 to 50, 50 to 200. Are we going to go back up here to test that 50 again? That's almost the same number as our 200 daily moving average, currently at about 412. This article was published about a week ago. We do have the bullish volume, so there is some positive momentum being built. And closing at the high of the week over last week's high with some added shorts really tells us that if we're due for a bounce, the bulls have to make their stand right here, right now, and make these charts go up. So at a very high level, that is probably the most important thing we're going to be going through this week. So another thing to keep in mind is that the fear and greed index is now actually back into neutral, which means that it's now actually going to be easier for us to push higher or into greed if that's where the market wants to go. I say that as well because we were looking at scenario 1 versus scenario 2. And in our scenario 2, which was the bull market, we were looking for the low, like we did in February, to cause us to go up, ultimately come back down to test, and then continue higher. So what this tells us is pretty much the same thing as what we're looking at here on our daily chart. For SPY, we now note that we're looking back to the period where we have this right here, which is the green box, just like we do now. What's so important is that there is roughly an inverse head and shoulders that is formed out of this pattern. So what do we have here? Well, we also have that inverse head and shoulders. And when I look to the period where we really start jacking up hard before we ultimately come back down and find our higher low, that's what we really haven't done yet. That is how the weekly higher low, the weekly higher high could get formed, where inside of this range right here, like in 2008, we just form those higher highs, higher highs, higher highs, higher highs. There are some traps, right? There are some periods here where we have a lower low, but ultimately we close at the high that week. So that's what I'm watching for. Where do we ultimately come back down to? And where do we find that higher low? This is going to be particularly important for me as well because we just had OPEX, and OPEX generally, not always, but generally, wherever the market wants to go for the next month, for the first week, we generally have an opposite move. The opposite move meaning if the goal is to ultimately be higher 28 days out, like maybe the goal is now, they usually have an opposite move before the true move. And that's just the way that options work. To not overcomplicate it, that is just how it normally works. And it's something I'm paying attention to here. So that short-term dip, this would form a weekly higher low, higher low, higher low. And that's really what I want to watch here. So if we're going to build momentum, I want to see consecutive higher highs, regardless of what happens with the lows. I want to see those higher highs, which means we're pushing further and further higher. And ultimately, there's going to be some reasons why that could happen. So we talked about the fear and greed. We talked about scenario two. Stock market. Before we look at that article, just want to look at this one here. Stock market, stock manager paranoia is only thing that market has going for it. Seasonal pattern puts equity bears on alert for year-end rally. Active manager poll option activity show fear of missing out. That is right, fear of missing out, FOMO, in a bear market. Why? We'll go through that. In terms of the seasonality chart, what people are focused on here is that I'm recording this on October 22nd. And as we get closer to the later part of October, it's straight up in a second year of a Democratic president. It's straight up in every term, including all years, all midterms, and everything. It's just a straight line higher. So that's what we're kind of looking for. We're kind of looking for a year-end rally. And remembering that stock managers or money managers, portfolio managers, whatever you want to call them, they have to beat the market. That is their job. Most fund managers are aware of the seasonal trends. So a move up, even if it's a bear market rally, it could go a little bit more than one would think because positioning is so light. And when we talk about positioning being light, I think I have a, give me 1 second here. I want to pull up the relevant screenshot because it's really important. When we look here to the this screenshot right here, it tells us that chasing gains, active money managers boost equity exposure from a 2-year low, which means their job is to beat the index, and the index is SPY. So when they have all this dry powder on the side and they've been holding on for more than 2 years, that's what they're talking about. Total assets for money market funds, which means they got about $4.5 trillion sitting in cash. When the market goes up by 5% and they don't beat the market, that is a bad look for them. Why are they managing money if they can't beat the market? So that's the first thing. Second thing here is just that resisting yield pressure. Stocks rise despite higher treasury rates. Why? There doesn't have to be a reason why. It's just the way it is. So markets are currently either wrong or the treasury market's either wrong and will mean revert over time. Doesn't have to happen all at once. And then there's that FOMO thing we talked about. Traders push the cost of bullish options to 8-year high versus bearish puts. One more time. Traders push the cost of bullish options to 8-year high versus bearish puts. That could cause the upside squeeze or basically the gamma squeeze, which means we could go higher. And people are positioned for the end of year rally. So seasonally, historically, 2008, we look here at the 60-40 portfolio. It is off to its worst year-to-date return in more than 100 years. So even inside of bear markets, we do get relief. That's what a bear market bounce is. Bear market bounce, dead cat bounce, relief rally. They're all the same thing. 2008 shows us that we're due for that bounce. Maybe it fails in the end of the year. Maybe this time's different. We also look here at a different overlay where it shows us that it's pretty much on track here too. Chop to chop to chop to chop to chop. This is more of a daily chart versus the other one, which is going to be a weekly chart. So inside of here, we note that we're like, whoa, we're like really choppy in here. But it still feeds through to our story of we're going to form those higher highs until we don't. And that's where we go up, stop going up, and then we start going back down. So all these things pretty much tell us the same story here. We also look at the VIX in 2008 versus 2022. And the VIX going down means that volatility is decreasing or the market is gaining more certainty. And right now, as we look to our fear and greed index, the market is absolutely feeling less fearful. If people are less fearful, it means they don't need to buy as much insurance, at least for now. And as we look here to where this starts going back up, we're going to talk about the reasons why this could still be a strong possibility. All right, moving forward. So there you go. At a very high level, that is what we're looking at. The daily charts tell us that we're also at an inflection point where we're now meeting our dominant downtrend, and we're either going to pass or fail on an absolute basis. Not only is SPY here, QQQ is also at that same crossroads, coming from the dungeon or all the way at the bottom of the chart. It is trying to reclaim key areas like the 200 weekly, like the 50 monthly, and its primary downtrend here, or that blue line, with a bullish pattern inside of it or an inverse head and shoulders. So if we now look to SPY on the weekly chart, what I'm really paying attention to is going to be 384. 384 is going to be where we exit bear market territory. Not only are we going to exit bear market territory, we've bounced off the 200 weekly a couple of times, and that number is going to come up a few times in this video. So just stay tuned as we go through that. Looking at QQQ, very similar. So we've had 3 consecutive weekly closes below the 200 weekly, which is always bad, but now we're back above by about $1.30 here-ish. And we note that we're right here at our weekly downtrend, which means that we're either going to break higher, release some pressure, or we're not. We're just going to resume lower. And with earnings in focus this week, I really, really, really want to pay attention to those levels. Last thing to look at here is just SPY, and we look at the weekly chart, and we're going to look at a quick options chain as a preview for where people think we could go. Where is the interest? Where's the desire to buy? I'm looking at one chain specifically, October 28th. We're looking at SPY on the 16s. And what I'm noting here is just that there is massive open interest, but also volume at 380 call. That 380 call, if we take that number plus the prem or the premium, that becomes 383. 383 would be break even, or where do they get their money back? Why is that so important? 384 or $1 in the money is where that negative 20% aligns, which means they're basically betting that we're going to be exiting the bear market territory one more time and closing next Friday above 383. But if they want some money, we got to be basically above 384 or higher. So there's a little bit of evidence. Moving forward. So now we're going to go through this article, and I'm going to try to go through this a little bit fast, but I want to make sure that there is context in regards to what we mentioned for us to actually go high. So Mike Wilson is smarter than me. He works at Morgan Stanley. He's the chief economist there. And I'm just going to go through this article, pull out some relevant sections, and we're going to try to explain what he's telling us, because a week ago on October 17th, he told us that the market could go to 4,000. And we just put in a 4.6% week on S&P. And on the NASDAQ, we put in a 5.6% week. This guy looks smart. And if he's smart, let's see whether or not there is a credence to his story, because he called the drop. Similar to when I called the bear market drop in October, November, December of last year. I'm now looking for the bear market bounce before the ultimate collapse. And this guy's smarter than me, which means that he can articulate it better than I can. A bear market rally began last week, and the inflation picture could rise to big move before stocks resumed a downward trajectory. Morgan Stanley equity strategist Mike Wilson. From our vantage point, inflation has peaked. 8% is hardly a rate that the Fed can live with, but if you look out 6 months, and by the way, if you want to sign up for a Seeking Alpha premium account, there is a link in the description for you to do that. And that also includes a discount and 1 free month. So make sure to click on the link in the description to know more about that. The seeds have been sown for lower prices in many goods and services. And that's what we saw with that Wall Street Journal article on Friday, where they pretty much didn't tell us anything new, but the market's like, sigh of relief, going up. If rates begin to discount falling inflation, it will give legs to a rally that began last Thursday. There we go. So the first part here is he's talking about if rates begin to discount falling inflation, which they are. Larry Summers, who has been very adamant on this story, has told us that the terminal rate, according to the Fed funds futures, has risen just above 5%. This is kind of a milestone. I think it is more likely than not to rise more, but the increase already of more than 400 basis points in 18 months is surely most of the increase we will see in this cycle. There you go. That guy used to work. He used to be the big guy. When we look here to what he's talking about, to discount falling inflation. Again, what we're looking at here is that Fed hikes are starting to discount it. This is the implied overnight rate and number of hikes or cuts going all the way through to 2023. And we now note that we have that micro dip and a forecast. That's what we're talking about. It's that simple. That's the first part of the story here. We're now going to move forward. It will give legs to the rally that began last Thursday, particularly if third quarter earnings season does not bring the step function decline to 2023 EPS forecast we still think is coming. So what does that mean? It means that the earnings for this week, we'll come back to the screenshot in a moment. We look here and note that, oh my goodness, there's like $15 trillion reporting. That is right. We got $15 trillion reporting on October 24th. This is the big one. This is the Super Bowl. This is all those big companies like Microsoft, Alphabet, Meta, right? Apple, Amazon, right? Those are all big companies. And whatever they say collectively is really going to tell us here. Wilson on risk, the same guy, Mike Wilson. Markets often need the engraved invitation from a higher power to tell them what's going on. For bond markets, it's the Fed. And for the stock market and for stocks, it's company management teams. I don't think that they're going to say that things are all that bad because this quarter looked pretty good. How do I know that? Well, when we look here, we're expecting a beat from Microsoft, a beat from Alphabet, a beat from Apple, a miss from Amazon, a miss from Meta. If that's the results on Friday, I would say, so what? We were expecting like so much worse. So with this being the Super Bowl this week, and as of right now, again, these are whisper numbers. You can go to the ideas channel if you want to see all the individual comments. What this also means is that right now, people are largely worried about the future forward PE, which means what companies will be worth in the future. And PE is derived from two numbers, price and earnings. So as the price has dropped dramatically, and oh boy, has it dropped dramatically, if the earnings hold up, meaning companies don't tell us it's going to be worse in the future than it is today, the price over earnings can actually remain at a price where it is a bargain for now into this earnings season. That's what Mike Wilson's talking about. And the reason why I believe this could happen is because when we look here to third quarter GDP, which is going to be reported on on Thursday morning pre-market, we're expecting 2.85%. The gross domestic product, or GDP, expanded 3% basically in the third quarter. Whoa. So what does that mean? People bought stuff. They bought a lot of stuff. They bought more than before. So that's what could cause these individual companies to tell us that, yes, for now, we are not currently in a recession, but maybe the recession is starting in the fourth quarter. That's what everyone's talking about. So that's what we're looking at here. Wilson said the equity team is becoming more skeptical this quarter will bring enough earnings capitulation from companies on next year's numbers for the final price lows of this bear market to happen now, which means they still think they can right the ship, they can save it. They're not going to tell us that they're either going to do really poorly. Remember, Apple and FedEx both guided down ahead of time to soften the blow when they actually don't beat. And now Apple is actually expecting a beat by 2 or 3 cents on EPS. So lower the bar going into earnings to be able to beat the bar when they actually report. SPY to 4150. If the rally holds, it could push the S&P to 4,000 and an attempt to retake the 200-day moving average at around 4150 shouldn't be ruled out. While that seems like an awfully big move, and I'm sure there'll be tons of comments that tell me this is true, it would be in line with prior bear market rallies this year and prior ones. But while the 200 weekly moving average around 35.85 was taking out on a Friday close, it is a formidable level that won't be taken out without a fight. Isn't that what we just talked about on QQQ and SPY? Yes. SPY actually hovered around here, only actually getting one close below, one back above, and then one back below, and now back above, which means it's formidable. There's buyers and sellers who were fighting on the NASDAQ 3 in a row, but now it's back above. So it's a formidable level. Yes, that is exactly what he's saying. In fact, it usually takes a full-blown recession, which we don't have yet. So let's go to our next section here. Let's pull that one to the back. There we go. In fact, it usually takes a full-blown recession, which we don't have yet. What he means by don't have yet is the S&P only takes out the 200-week moving average if there is a recession. The recession is going to come later, which would mean that our 2008 versus 2022 would cause us to lose our 200 weekly at a later time, like in 3 months, like 3 months from now, which would be the beginning of next year. That's what he's talking about. When the recession is confirmed, maybe that's when we actually lose that 200 weekly moving average. Why? Like we just talked about, GDP is expected to tick higher by about 3% when it's reported on Thursday. So when we look here to GDP, which is going to be coming in on Thursday, currently forecasted at 2.1. The St. Louis Fed forecasting at 2.8. Oh boy, would that be a crush. Core PCE coming in on Friday as well, which is the Fed's favorite gauge. And here we're showing a decrease versus the previous period, 0.6 to 0.5. What'll be the number? I have no idea. Is good data going to be good? Is bad data going to be good? I also do not know. That's what's really interesting about where we currently are. Something else we want to notice that the bears actually added a significant back to their short, almost all the way back to the heights they were at. And this is as we're closing at the high of the week. So as we're closing at the high of the week, and they added back 40,000 more contracts. Sorry, 60,000 more contracts. That's a lot. If they are wrong, they're going to squeeze us higher into the early part of the week. We won't really need much else. If they are going to hold on, then maybe they're going to add more this week. Second, not all recessions result in a break of the 200-week moving average. So there is also a case to be made. We won't take it out even if a recession arrives, which means we have to push off. So we have a cushion if we want to retest it. Blah, 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 blah. We're just going to look at this last part here. To be crystal clear, we think a tradable bear market rally began last Thursday, which was 2 weeks ago now. However, we also believe the 200-week moving average will eventually give way like it typically does when earnings forecast fall by 20+%. The final price lows for this bear market are likely to be closer to 3,000 to 3,200. So at a very high level, that is really what we're looking at going into this week. We talked about the options. And now, if you are interested in trading with me to see how I am taking all of these notes that I just prepared to formulate them into a trade plan, you can subscribe to the channel. Or if you want to join us in our private group, you can go to the link in the description or in the top comment, and you can trade with me, Justin. Otherwise, there will be a video that queues up here in a moment from last weekend where we talk about scenario 1 and 2, where we could go higher or lower. If not, I look forward to seeing you on our next upload, which will be on Monday. Thank you so much. Happy weekend.